welcome. Good to see everybody on. Nice pre-chat going on there, and we'll just leave the pre-show on for a couple of moments just to let things settle. People always come in a bit late for these events. Another cool evening here, but great to have you on. Lot to talk about tonight. It's a bit of an old-fashioned show with just me, no guests, just me and my data, which is how we started many moons ago. And there's a lot to talk about tonight, I think, as well. And hope everybody's well. And we will just say the doggies are still there. You did get a bit of action during the pre-show, those who were on early. Luna is the one with the light-coloured paw. Misha is the one in a little black ball. And they've both been out for their walks a little while ago, so they'll probably be staying there until I take them out for their late evening walk a little later. They always get 4 walks now, 4 walks every day, so it's good for them, probably good for me as well. And they actually come up to me and say, come on then, let's go, at the right times. It's amazing how dogs know when the time is. They know for feeding time and walking time. So they've got it all down without a watch. How do they do that? I don't know. Anyway, let's take the pre-show off. And I'm going to run the introduction, and I'll be back in just a moment. Well, good evening and welcome to this live stream event on the 6th of September 2022. Martin North from Digital Finance Analytics here. Great to have you on the show, and thanks for spending a bit of your time with me this evening. No guest tonight, it's just me and the data, but we're going to have a deep dive into some of the analysis that I've been doing and perhaps talk about the RBA and what they've been up to, and also plenty of time to ask and answer questions in the chat as well, so should be fun. And I have a feeling this show might go on a bit. Cookie Boy's been very, very busy. And shout out to Cookie Boy for 2 things. One is for retweeting the invite beforehand. If anybody wants to make a donation to Asbestos Awareness Australia, Cookie Boy's going to make a donation if you retweet his tweet about the show. So go across to Twitter if you haven't done so and make that happen. That would be great. And the other thing Cookie, of course, has done is a lot of the research with regard to some of the properties we're going to look at later, because there are some interesting trends emerging. So that's a very important discussion, and Cookie Boy, very much appreciate your help on that. And here we go. Now, just before I get started, I will just, as normal, remind you that we do, of course, just cover the house rules. We don't provide financial advice on the channel. This is no legal advice. This is just a general conversation. Please don't take it as financial advice. If you need a financial advisor, go get one. Don't come to me. I'm not qualified to give financial advice. I don't give it. Also, chat room is moderated. Please just treat it with respect. But I do encourage you to chat and share your views. This is as at the 6th of September 2022, if you're watching in replay. And if you'd like to ask a question, get my attention, use it at Walk the World. That puts it in my special queue so that I see it. I've also enabled Super Chat, and that means that you can get your question to the top of the list if you would like to do that, or indeed make a contribution to what we do around here. It's really greatly appreciated. It does help to cover some of the costs. We don't do this because of profit motive. It's simply that it does help us to cover some of the costs involved in, well, just dealing with all of the things that we do all the time. So it is greatly appreciated. Now, I thought we would start with the RBA's statement today. I don't know whether you missed it or not, but anyway, let's just go through it. So basically, the statement was not really a great surprise. At its meeting today, the board decided to increase the cash rate by 50 basis points to 2.35%, and it also increased the interest rate on exchange settlement balances by 50 basis points to 2.25%. In other words, money held by the banks at the RBA in those exchange settlement accounts get interest at the same rate, 2.25%, And of course, a lot of that is term funding facility money that was extremely cheaply lent to the banks initially. So we are actually supporting the banks. I hope you feel good about that. They're saying they're committed to the 2-3% range of inflation over time. And then they talk about some international situations. Inflation in Australia is the highest it's been since the early 1990s. And this is important, expected to increase further over the months ahead. Then they say that global factors are part of the reason, but also domestic factors are playing a role. Upward pressure on prices from strong demand, a tight labour market and capacity constraints. And they go on to say inflation is expected to peak later this year and then decline towards 2-3%. And it's about the resolution of global supply chain, blah, 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 all that sort of stuff. Their central forecast is CPI to be at 7.75 over 2022. That's a really weird way of putting it. That would suggest it's going to peak a lot higher than that and then come back a bit, maybe. I don't know. That's a little bit, and going to be a little above 4% over 2023 and around 3% over 2024. In other words, next 2 years, inflation is going to be over target. So don't expect interest rates to come down any sooner. Then he went on to talk about the unemployment rate. Further decline in the rate is possible. Some increase in the unemployment rate is expected as economic growth slows. So they are expecting now the unemployment rate to start rising later. Wages growth has picked up, they say. Believe that when I see it. And they're paying close attention to the labour market. And then they went on to talk about source of uncertainty is household spending. Consumer confidence has fallen. House prices are declining in most markets. And many households have large financial buffers and savings rate remains higher than before the pandemic. Those financial buffers, of course, are not equally spread, as I often say. Going on to say price stability is a prerequisite for a strong economy and the size and timing of future interest rates will be guided by the incoming data and the board's assessment of the outlook for inflation. In other words, they don't quite know. It's going to be pulling the levers a bit more, but I also translate that as it rather depends on what the Fed does. Remember that the RBA is very strongly connected to what the Fed is doing, and through Jackson Hole, I did some shows last week on Jackson Hole. Jackson Hole was higher rates for longer. Therefore, in Australia, higher rates for longer are coming as well. So that's pretty much what the RBA said. Actually, in a way, there was almost no change from, from what they said last month, other than the interest rate itself. The same trajectory and all of those things. But it is concerning that we're going to see rates rise even higher, of course. And I guess my perspective will be that we are going to see rates rise probably higher than CBA thinks, because they're talking about 2.6. ANZ is talking about 3.25 or 3.35, something like that. Now, the interbank cash rate at the moment, this is the 30-day implied futures. This is the one after the close of play tonight, shows they're talking now, this is the market expectation, of course, may not happen. They're talking about a peak rate of about 3.775 in August next year. That's come down. It was at 3.9 a couple of days ago. But they're talking in February 2024 at 3.6. Now, 3.6 is obviously well higher than where we currently are. So that is a very significant thing to bear in mind. So the market is saying we don't think rates are coming down anytime soon. And that's, of course, very significant in terms of thinking what may play out. Now, just to remind you, and I use this as a model just to show you the impact. If you have a $100,000 and your mortgage rate was 1.99%, your monthly repayments are $365. If it goes up to 3%, so in other words, a 1% rise, that's up 15.6%, now $422 a month. If it goes up 2%, it's up 31% from that baseline, $478 a month. And here's another way of looking at it. This is from CanStar, who said, look, a $500,000 mortgage went up by $68 a month in May, $139 in June, $140 in July. In August, $148, September, $153. The total in 5 months, $652 per month. And that's assuming a 30-year loan and $500,000. $1 million, that's more than $1,300 a month. That's enough to make your eyes water. So these are big increases. And the point I'd like to make, and it's very important to underscore, that this, of course, has not flowed through yet, because it takes 2 to 3 months for the impact of those mortgage rate increases to hit real households. And in fact, in my surveys, I'm still seeing people saying, oh, it doesn't seem too bad. But when you look, they've only had 1 or maybe 2 increases so far. There's another 3 in the pipeline now. And that means that people are going to find it quite difficult to navigate ahead. Now, here's a couple of other interesting slides which I thought I'd just touch on today. The first one is from Louis Christopher. So he said that the property listings surprisingly fell over the month of August right across the country. Normally August is the month when listings start to rise ahead of the spring selling season. So he said, it suggests to me spring is going to be a weaker on the activity front. Vendors are clearly cautious to sell in this environment. There's no panic selling at this stage. Well, we'll wait and see whether that translates. But I will also make the point that different listings are happening in different locations. So you can see that less than 30-day listings are up over the year in Sydney and Melbourne, but down over the month. In some other cases, it's a bit different. And if you look at old listings, you can see, again, there's some quite significant variations. The drop in Brisbane is quite interesting, particularly over the year. But now listings are higher. And interestingly, of course, in Perth, listings are down a little. So it does vary. And Canberra listings up from old listings quite a lot, but they're down for new listings. So that's interesting. So I think my conclusion there is that a lot of the property that's on the market at the moment is not necessarily your A-class property. A lot of it is, been around a bit. But there are still some new properties coming on. And interestingly, my conversations with a number of estate agents across the country are suggesting that the listings will be rising because there are more properties to come on as we move into September and October. So we'll see whether that transpires or not. Second point to talk about is consumer confidence. This is from the ANZ and Roy Morgan. But they said that consumer confidence did increase slightly by 1.3%. Which is the highest level since June. But the really interesting thing here is that whilst those renting confidence jumped, for people paying off a mortgage and for those who own their home, confidence is sharply lower by 19 and 13% respectively since the RBA's first rate cut in May. So that really is telling you the story. So the rate rises are actually having a significant impact in household consumer confidence. And that means that it remains deeply negative. And of course, my perspective here is that now people are going to find that as things bite, they're going to spend less. So spending has been quite buoyant up till now. It's one of the reasons why the RBA is still lifting rates. But ahead, we might see that turning around. I guess the other point to make is that if it takes 3 months or so to trickle through, essentially the RBA is lifting rates without necessarily having the data back to prove where they got to. So it'll be interesting to see whether they pause at some point and take stock, or whether they just keep charging forward. And that, of course, is one of the open questions at the moment, I think. Now, I will then just move on to talk about stress at the moment. But before I do that, let me just have a quick look at the chat and just see whether there's anything I want to pick up. Lots of questions I see, and appreciate all of the chat. Thanks very much for the coffee. Appreciate that. Interested in the eastern suburbs of Victoria, 3134. I'm going to put that on the list. 3134 and 3135. I like the etc. It's hard to actually etc. But if you put up specific ones, I will try and get to specific examples in postcodes as we go through. Cookie Boy says, thanks for the plug and kind words. Well, Cookie, you deserve them. You've done great work on helping to get people to be aware of what's going on. What with your contribution on Twitter and also here, it's really appreciated. Thanks, Vanessa, for that. Yeah, I think we've got a great community here, a lot of respect for each other, but also some very interesting ideas. And I really like that. That's one of the reasons why I like keeping this community going. Very important as well, I think, in the current environment. What else have we got? So Nick is asking about the financial buffers. I'll talk about that a bit later when I look at the surveys, because there is a real weird thing going on with the RBA saying everybody's got buffers. No. Some people have buffers. And interestingly, some of the people who have buffers are relying on the superannuation withdrawals that they pulled out last year and the year before. But we'll see. It's like RBA interest rate pawns, said George. Very good. Yeah. Glad that you like the channel, and thanks for dropping by. It's really good to see everybody. Okay, and this is an interesting one. Is there any counter-argument for house prices to decline lower than the market prediction due to the shortage of new builds and increased migration? Keen to get a view on 3216. Well, I'll put that on the list. 3216. I'll come back to that a bit later. But in terms of house price trajectory, there are two things to understand. The demand for new builds has come way off because that was pulled forward by the government stimulus packages. And so there is less demand ahead. Also, borrowing power has been reduced, maybe 22% on average because of those higher interest rates, because you add a 3% buffer on top. And that basically means that people can borrow less now, so they're less able to get in. Also, if people think prices are going to go further down, then they're going to wait and not buy. So that's one of the things that I'm finding now when I talk to some of my one-on-one conversations. A lot of people are saying, I'm just going to wait and see. I'm not going to do anything immediately. So the migration thing, that will have a small effect, but of course it's going to take time. It's 35,000 additional places under the long-term migration scheme. But it will take some time to process that. They've got many visas to process beforehand. And a lot of those people who come into the country first rent. So it might put pressure on the rental sector, and then buy later when they sort of learn their way around the country. So to my mind, neither of those two factors are sufficiently strong to put a support under house prices. Or to put it another way, the biggest by far of all the levers in the pantheon of the levers you've got is credit availability. Credit is tighter now because rates are higher. The borrowing power has been reduced, and the appetite is also down a little bit because some people are waiting. So that would be my argument as to why I think it's going to play out the way I think it is. Okay, what else have we got? Oops. Appreciate the contribution there. Thank you so much. I really do appreciate these super chats. They really make a huge difference to what we do here. MJB says better for the RBA to overshoot and then cut a bit rather than undershoot. Yeah, the point about that is you're dead right. Inflation, if it gets embedded, is really hard to strangle out. And in fact, it took almost a decade in the 90s, 70s, 80s, 90s to get it under control. We want to make sure that it is snuffed out, which is why all the central banks are now saying raise rates and raise them much higher. The Jackson Hole thing was very determinative in terms of what's going to happen from this point, not just here but around the world. And pretty much all central banks are now committed to raising rates significantly. Very significant turnaround from just a few months ago when, of course, they were all in quantitative easing territory and ultra-low territory. So we are definitely on a different path now. Okay. Jason said, price of one coffee in December, where inflation is moving. Thank you, Jason. Indeed, yeah, don't. It is unfortunately the case, isn't it? It's pretty scary. I've actually given up buying coffee at the coffee shop. I make my own now, I'm afraid. And Cookie Boy asked about the dollar. Yeah, that's because of the strength of the US dollar, I think. The US dollar is still very strong at the moment, and there were some movements with regards to oil. So oil supply is being tightened because of OPEC Plus, and of course the petrodollar and the dollar are very strongly connected. And the other thing, of course, is that the gas price has gone higher again. which is putting more pressure on the other currencies around the world, which puts the dollar up as well. So I think those are some of the reasons why that is what has happened. George said, what is the volition of money doing? I assume you mean the volatility, you mean the rate of moving of money around the... It's high, it's slowing. So if you look at the M1 and M2, it's actually come back a bit. I did a show about that some time ago. And in fact, overall liquidity in the financial markets is degrading, partly because of quantitative tightening and partly because the amount of new stuff being written is down as well. So there's a whole bunch of reasons why I think that the economy is tightening. And Nick asks, can you explain a bit more detail why credit availability is more relevant than the supply and demand of property? Yeah, so I did a lot of modelling on this over the last 3 or 4 years. And in fact, if you go back in the archive, you can actually see a show I did when I took apart all of the elements that actually go to property demand and property supply. And clearly demand and supply is important. It's one of the factors. But by far, the biggest was credit availability. And if you go back and listen to some of my shows with Steve Keen, Steve and I discussed this. The biggest element is credit because most people, when they buy a property, need credit. If credit is available and you can get multiple of your income, 7, 8, 9 times, and if rates are really low, so your affordability parameters are also generous, then that chases prices higher. As prices go higher, banks will lend more, and so that virtuous loop is actually way more important than the absolute demand and supply. Those sort of things are there. In fact, migration is also another factor in, and a few other things too. But by far, it's interest rates and credit availability that is about 70 to 80% of the reasons why prices move, which also means that, no surprise, over the last few years as rates have come down, and rates came down much lower than I expected from the Reserve Bank. As a result of that, house prices went through the roof. That's why we got the 20 to 30% rise over the last 18 months or so. But the reverse is also true. As credit is rationed and tightened, and as the banks effectively are having to look at that 3% buffer in a new light, you add it to the new mortgage rate and then add it 3% and say, can they still afford it? So we're looking at 7, 8% in some cases now. That means that people will be not able to get as much credit, therefore they can't borrow as much, therefore they can't pay as much, therefore prices come down to meet that. And that's the sort of the mechanism that I see. And it's worth just saying that the fundamental important thing to understand here is that banks create credit. They create money by creating credit. It's an electronic entry, right? It's not deposits first, it's credit first. And so if the banks are lending less, and now lending is coming off, and if they're having to charge more for it, those two things are both economically quite important in terms of understanding why the economy might actually grind. Okay, now let me go back then to the next part of the show. I want to talk a bit more about mortgage stress, and I'll just start with a definition. This is important because I have people sort of confused about my definition of stress. So there are many different definitions out there, 30% of income, or it could be 30% of taxable income, or it could be underwriting metrics like the banks use, and like Roy Morgan uses that particular one. But I define stress in cash flow terms. I look at money in, money out. And essentially, if households have more going out each month, more outgoings, excluding, say, one-off discretionary items like, holiday or those sorts of things. But if they've got more going out than income, we define them as stressed. If they have the mortgage, then they are in mortgage stress. And if they're renting, then they're in rental stress. So that's how we do it. We also look at investors with a cash flow pressure, and if they have cash flow pressures, they're identified as stressed investors. I also aggregate the data to estimate the total financial stress, which is effectively an aggregate at the postcode level. And we express it as a percentage of households and a count of households. And very important to say, I think the latter is a better measure rather than the percentages of households, simply because if you have a very small number of households in a postcode and a few of them are stressed, you can actually get a very high percentage. Doesn't really tell you much. I think the true story is the number. So you look at the big numbers. So I tend to look at the big numbers. And I also should say that we use our model. So this is the model. This is my universe. I spend all my time thinking about this. So we survey households, or we pull information from all sorts of other areas into our core market model. We also slice and dice the data, Rubik's Cube style. And using our scenarios, we can then form some views about where things are going. And of course, by taking stress, trajectory of prices, buying and selling intentions, migration, the economic data through the core market model and scenarios, we can then come up with some views about postcodes and where they're going. And by the way, just to re-emphasize, I do also provide a one-to-one service where if you want a conversation about an individual suburb or postcode, I can't give specific financial advice, but I can show you my data and how it works and look at the underlying trends. So things like stress, home price trend data, and where the prices may be going. And you can book a time for that by Zoom or phone, up to an hour. There is a cost involved because it takes quite a lot of research on my behalf, typically half a day per session. And we're booking 3 to 5 weeks out now. If you want to follow that up, then go across to my blog. Down on the blog, there's a little contact me form. It sits down at the bottom right-hand side of the screen, and you can actually contact me directly there, and we can tee something up. Anyway, let's look at mortgage stress now. And just to give you the trend data first, this is rental stress. 52% of households, never been higher. That's about 1.9 million households in rental stress. And mortgage stress at 46.2%, never been higher. That's really high. And by the way, of course, the household debt is also very high at the moment, 187.2. So that's the story. Now, I did make a show where I went through these numbers in detail, so I'm not going to do that again tonight. So there's a link below if you want to go and look at the earlier show. But just to highlight, total mortgage stress, 46.19%. That's 1.7 million households in mortgage stress across the country. You can see that the largest number in New South Wales, then Victoria, then Queensland, WA, and some of the other places are a little less represented because, of course, the population is less. Rental stress is also very high, and there 52.07% translates to nearly 1.9 million households in rental stress. And again, it's spread across the various postcodes, but I would highlight that New South Wales had a real hotspot now in rental stress. That's a real problem. That's partly a function of high home prices as well. And there's also the financial stress and investor stress. And if I go to the next slide briefly, this is actually just showing you that the different segments that we use in our model, from young growing families, there were a lot of the first-time buyers, 81% in mortgage stress, through to the first-generation Australians, the multicultural establishment people, 42%, but 68% in rental stress, so they're actually quite often in significant rental stress. Then some of the more affluent households, like the exclusive professionals and young affluents, and then the disadvantaged fringe as well. So it's quite widespread. And of course, later I'll show you some of the mapping that I do to give you a sense of how it's distributed across the country. Because I actually think the mapping, in a way, gives you probably the best indication of what's going on. But I will just show you this slide. So this is actually mortgage stress. And I won't go through this in detail, but I want to highlight that places like 2560, which includes Campbelltown, and 2170, which includes Liverpool, and then places around Toowoomba in Queensland, and there's a Western Australian one. Then we go to Cranbourne and Berwick and Harkaway and a few others too. They are all high growth corridors. In other words, there's a lot of building and construction been going on recently. And that's where a lot of hotspots are, because people bought properties relatively recently and they've got big mortgages. They're highly leveraged up, but they're also in areas where the infrastructure is not particularly strong, so they have to drive a lot. They have to spend a lot much more on transport and other things, and plus childcare and everything else. So that's the reason why these are very, very sensitive to particularly interest rate rises. And I see this more and more now as things develop. And I'll just sort of show you what I mean by that. by switching across to this particular view here. Whoops, I might just change that to there. Hang on a moment. Let's just do that and do that. There we go. All right, so this is actually Melbourne. And this is a dynamic model, so we can drill and drill out. I might just come in a little bit. So the way this works is that the highest number, this is a count of households in mortgage stress, are the sort of the reddy colour, and it goes sort of reddy, orangey, yellowy, and blue is the good ones. And so you can see there almost immediately that closer into Melbourne there isn't too much. There's a few, but as you come out, you can see there that the story starts to develop quite strongly. And so places around the western side towards Wyndham, and also down towards Greater Dandenong and beyond. And this is where a lot of the new developments are. You know, Narre Warren and places like that. That's all down there, Berwick and Harkaway. And if you pull out a bit further, you can see also that it begins to now show in Ballarat, for example, over there as well. So some of the regional centres. So it tells you quite significantly where those hotspots actually are. And the beauty of this model is that I can then jump to, let's go to Sydney just as an example, right? And we can jump into Sydney. So we start in postcode 2000, which is looking pretty good for mortgage stress. But then as we pull out, we again have a somewhat similar story, where effectively there are some areas where mortgage stress is starting to build and build quite significantly. I'm just going to move slightly across. I always wondered if I could automate this into a video, but I've not been able to find a way to do that, so I have to do this manually, which means driving the mouse. So you get smooth depending on how smooth my mouse driving is. Anyway, here we go. So you can now see that Campbelltown there, up in the hills and around the areas there, and there's Blacktown, Liverpool, and in those areas there, they're the real hotspots in terms of numbers. But if you look a little closer out as well, you can start to see that beyond Sydney, you start to see these other areas too. And if you look more closely and at some areas closer into the city, you know, there are a few hotspots, but nowhere near as significant. But even places like Mossman and Woollahra, there are some people who are actually finding it quite difficult. And the Northern Beaches too. Now, those are very relevant observations, as you'll see very shortly when I start talking about individual examples. Okay, I'm just going to do one more. Let's do Brisbane. And then if you want me to do some more maps, put the message in the chat and I'll try and do it a bit later. So this is Brisbane. And once again, this is showing you the story of mortgage stress in and around Brisbane. So you can see that the overall pallor is different. That's partly because, of course, the number of households is lower compared to Sydney and Melbourne. But nevertheless, if you drop out and just see Ipswich and places like that, and places down on the Gold Coast, you can see there that there's a few areas that are also showing it, and a few areas south of Brisbane. And if we go north and go up that way, up towards some of the other areas, towards the Sunshine Coast and places like that, you can see that there are some hot spots further up the coast as well. Even sort of south of Noosa in some of those areas inland. So the numbers are lower, so you don't necessarily get the very, very hot numbers, but nevertheless it shows you that there is actually quite a lot going on there. So that's the mortgage stress mapping, and I can do that for the whole country, and I can, you know, drill into a particular area if you're interested in that. The other thing I have here, though, is actually my postcode modelling. And this, of course, is the thing that's available via Patreon for those who subscribe to Patreon. They can get it updated every month. But here is the base model. Let me just put this up on screen. I just need to do that. And then I need to do this. Oops. Should work now. Yep. It's quite complicated to show this on the screen. I have to go through a program called OBS, which is a sort of software tool that grabs stuff off a screen and then represents it in a way that I can then show on the screen. So that's why I have to just do that. And if I go there you go. So we're now looking at my model. This is essentially everything that I've got in my model. And I'll just highlight a couple of things that I think are quite important. The first is, oops, there we go there. That's better. First is we have it for pretty much every postcode. So you can bang your own postcode in and see the results, right? And then what I've got is information about the geographic footprint of that particular area, including the district and the long location with all the suburbs. I've also got some information about where it maps to SA3 and SA4, which are census and ABS data, also the electorate and a few other bits and pieces. But this is a really interesting thing. Households, about 12,000 households in postcode 2000. I break it down between those who own their property outright, those who are borrowing, so mortgaged, and those who are renting. And of course, in this postcode, the majority, 73%, are actually renting. And we also know how many people are actually offering investment properties in the area. And then we break that out. So those who are in mortgage stress or borrowing, those who are renters in rental stress, those who are investors in stress, and those overall in financial stress. So the financial stress is the aggregate across all households. And I then show them as a percentage. And then I look at the movements. Now, this is where my scenarios come in. And I've shown you the scenarios before, but what I now do is show you the relative trajectory of prices over 3 different scenarios. So scenario 1 is my best case scenario. And just to explain, the best case scenario is assuming, oops, let's do that. Excuse me. So the best case scenario assumes that rates don't go much higher. They come down, the RBA cuts rates, and as a result of that, we don't have more pressure on households. We also assume migration starts up quite strongly, and we assume that China continues to buy all our stuff. The Ukraine situation sort of eases back, and the oil price comes back. So that's sort of the best case scenario. The worst case scenario at the other end of the spectrum is that everything blows up, and we have considerable issues with power supplies. The gas price goes through the roof. Ukraine continues to get worse. The oil price goes a lot higher. Inflation is stuck and doesn't really shake down at all. All of those things. In that situation, interest rates go a lot higher. Confidence level drops through the floor. Unemployment rises significantly. All those things. And then the base case is my sort of intermediate one where I think, well, this is what I think most likely is going to happen. And that's on the assumption that we are going to see some inflation. It'll take a year or two for that to get adjusted. Migration will start up, but it will be quite slow. We're going to see interest rates definitely stronger for a period of time, but ultimately will come back a little bit. And the Ukraine thing will ultimately get contained, but not for the next year or so. And China will come out the back of its issues sort of into next year. So it's sort of an intermediate view. And from that, you can then see this is the cumulative movement of property prices. So if everything goes really well, it's feasible that prices will go roughly sideways for houses and pretty much for units. And I actually show them in numbers as well. The base case is a fall of about 20% over the next 3 years cumulatively. And the worst case is a fall of 40% in this particular postcode. Now, this is postcode specific because it's based on the data from the model, based on the surveys and everything else at the individual postcode. So if I then start looking at some of the examples that people asked for, 3144 was the first one that people asked about. So that includes Malvern and places like that. I think this was probably, the thought was this was Josh Frydenberg's old seat, right? So this is the story here. So there's 4,500 households. 41% own outright, 31% borrow, 27% rent. Mortgage stress is not particularly high. Rental stress is quite high at 64%. There is some stressed investors going on there. And so 52% of households overall are in financial stress. And the trajectory is best case slightly positive, the base case drop of about 20% for houses over 3 years, worst case about 35%. Units, well, following along. I also have in this data two other interesting things. Firstly, the average taxable income from the ATO. So that's per person, that's per individual. And the other is the gross investment and net investment returns on investment properties. So 3.5% is the gross investment returns on average in this postcode, but the net investment return is 0. So many investors are not making any cash flow at all in terms of that postcode. Now, if we then compare that with 2228, which was one that also people asked for beforehand, and here we've got 8,500 households, of which 28% own outright, 38% are borrowing, so more are borrowing, and 32% are renting. So this is Miranda and Yowie Bay in New South Wales, of course. Mortgage stress is at 17.2%. Rental stress is at 65.2%. A lot of renting problems. Stressed investors, 33%. And households in financial stress, 39%. And you can see there that prices are set to potentially go down about 14% over 3 years. Cumulative speaking, on my base case scenario, slightly more positive in the best case and negative in the worst case, down 32%. And I'll also highlight the fact that net investment returns in this postcode are negative 0.7% after all the costs and management of the investment property, which of course is the way you should look at it rather than the gross investment, which is just a theoretical and artificial number. Okay, now Ben asked about this one. This was postcode 2282, and this includes Warners Bay and Lakelands, and they're 6,500 households. 44% own outright, 37% are borrowing, 70% are renting, and 22% are in mortgage stress, 81% in rental stress, and there's a bit of investor stress. And the models say, well, best case 6% over 3 years, the base case down 16% over 3 years, and the worst case down 35%. And again, net investment returns in this postcode are negative. I'm going to go to 2259. So this is from MB, asked about Wyong. 24,900 households, 32% own outright, 40% are borrowing, and 26.5% are renting. And by the way, this is based on the base census 2021, so last year's census, so it's very recent. And look at this, 43% in mortgage stress, 77% in rental stress, 18% in stressed investors, and overall 43% of households in financial stress. As a result of that, the base case is down 16% over 3 years for houses. The best case slightly better, the worst case down 34%. And net investment returns just positive, but only just. And another one people asked for was 3134. We'll do that. Okay, so this is Ringwood and places like that, and Warren Wood in Victoria. 13,500 households, 29.8% own outright, 41% are borrowing, so a lot of mortgage households there, 28.7% renting, and only 4% in mortgage stress, rental stress 36%, stressed investors 18%, 70.8% of households in financial stress. That's somewhat low. As a result of that, best case scenario could see a rise of 16%, base case is a fall of 6%, and the worst case is a fall of 24% over 3 years, but net investment returns negative, just slightly. Most of Victorian postcodes tend to be a bit negative at the moment. 3135 was another one. This is the except, wasn't it? So this is a quite different one. This is Ringwood East. 8,000 households in that postcode, 32% owning outright, 43.5% borrowing, 24.5% renting, 59% in mortgage stress, 46% in rental stress. So this is a big deal. 16.8% stressed investors and 43% of households in financial stress. So Best case scenario, maybe a growth of 8%, but the base case a fall of 14% over 3 years, and worst case of 32%. Net investment returns are negative in this postcode. And the last one I'm going to do at the moment is 3216. So this is actually down Geelong Way. And there we have 33% owning outright of 23,800, 39.5% borrowing, 27.3% are renting. And there are 41.9% of borrowers in mortgage stress, 67% in rental stress, 17% stressed investors, and 40% in financial stress. And there the scenario is best case up 8% over 3 years, but look at this drop, slight rise, slight rise. 14% base case, 33% worst case. So there you go. That's how the model works. I'll come back and pick a few more postcodes a bit later when we've actually sort of progressed the conversation a little bit further. If you want to get hold of all of the information for all of the postcodes every month, then just go across to Patreon and you can sign up there, and we'll send it out every month to you as a spreadsheet where you can actually put in all the numbers and see all the information. We also have an online portal which is at the moment being refixed because there's a security issue that we're trying to deal with. So we're sending it out via spreadsheets at the moment. Okay, so what I want to do now is just talk a little bit about mortgage stress, but then I want to go on and talk a little bit about properties. And I want to make this point because I think it's really important. There are a number of people who are now feeling it at the moment, particularly with these high interest rates and higher interest rates ahead. And I just want to warn people, you want to be very careful about where you seek help. Obviously, seek help from the bank if you can talk to them. But if you need independent advice, it's very important that you don't go to one of the paid services that appear on the internet when you type debt advice. So I always recommend people go to the debt helpline. The number is there. It's 1-800-007-007. So think of 1-800 James Bond. And they offer both live chat and also phone counselling. It's free. It's a charity. It's a not-for-profit. And they do a really good job across the country. So that's the National Debt Helpline on 1-800-007-007. Why am I putting this up now? Because I want to make the point that if you are actually somebody who is beginning to feel the pressure now, and roughly 30% of households, I think, are now really having difficulty with dealing with some of these financial issues, it's important to plan ahead and get advice early. The worst thing to do is just assume it's going to fix itself. So if you have issues, if you have stress, pick up the phone, talk to somebody, get some help. And in fact, I think frankly, quite often it's useful to talk to a financial counsellor before you go talk to the bank, because the bank will offer you certain solutions, things like restructuring and refinancing, which may or may not be the right answer. And they often don't look at the total debt footprint that you've got. A financial counsellor can do that, because quite often what I find in my surveys is that people have big mortgages. They have other debts too, and trying to balance all of them is actually quite difficult. So I don't want to make a big thing of it, but there you go, National Debt Helpline. Now, let me then just put up a few of these. So this is Cookie Boy, and basically Cookie Boy's come up with all of these examples, because one of the things that everybody kept saying to me was, well, there's no examples of prices falling. Well, there is. These are examples. So this first one is actually a Victorian postcode 3188, and interestingly, they say the gross rental yield is 3.06, which is interesting. It makes you wonder about how they calculate those gross rental yields. Remember, the gross rental yield is relatively meaningless. And interestingly, in my analysis of that postcode through 3188, my gross investment return is 3.5%, so it's not too bad. But the net investment return is down 0.2%. That's quite interesting. And in my data here for that postcode, we find that there is actually not a huge amount of mortgage stress at the moment, but also ahead, we are looking in our base case of property prices sliding perhaps 40% cumulative over 3 years. So let's come back to that particular one. So what this one is a house. It was on 13th of August at 1.95. Now on the 31st of August, it's dropped to 1.875. Here's another example. This is postcode 3195, and that's at Parkdale, Victoria, 4-bedroom, 3-bathroom house. And the last listing was 1.8 to 1.9. And now it's at 1.85 private sale. And there's a bit of a history here. I won't go through into all of it, but it's been up and down. But one stage it was on for private sale at 2.150 million. So up and down like a yo-yo. And interestingly, if we would look at that postcode, 3195, the interesting observation there, go back to there, is that the net investment returns are negative, minus 0.3. The gross investment returns are 3.3%. And mortgage stress isn't too bad, but rental stress is pretty severe. As a result of that, our base case is a fall of about 12% over 3 years for property in this postcode. So it's maybe worth holding off rather than chasing that particular one in that particular postcode, I suspect. Now, if we look at the next one, this is 3065, another Victorian postcode. This is actually in Brunswick. And this is a 5-bedroom, 2-bathroom house. And it was on at 1.95 million on the 17th of July. Now it's at 1.85 on the 3rd of September. And if I put 3056 in the system, it comes up with a very interesting story. So here we have 11,000 households, but look at this, 54% in mortgage stress. In fact, 28.9% of borrowing, half of them, more than half, are in mortgage stress. There's rental stress there as well. The overall scenario is 65% of households in financial stress. And if you look at this, even the best case scenario is a rise of 2.5% cumulative over 3 years. The base case is a fall of 20%, and the worst case is a fall of 38%. Now that's because of this high level of stress and the demand-supply equilibrium there. And I'll also highlight the fact that the net investment return is 0.1%, the gross investment return is 3.2%. So you can start to see a bit of a pattern, right? Where stress is high, the prices tend to be sliding a bit more quickly. And I actually think that stress is quite a good proxy for some of these movements in price. Now we'll go to postcode 2261, and this is Chittaway Bay, and there the price was 1.37 on the 13th of July. Previous to that it was at 1.5, so we have a 1.5, 1.37, 1.275 is now where it is. And if we bang that one into the system, which is postcode 2261, and what we find is that the households are 22,000, borrowing 38, so it's quite a high indebted area, 36% in mortgage stress, 72% in rental stress. So the trajectory is, look, best case 6%, base case down 17%, worst case down 34%, and the net investment returns positive, 0.3%, gross investment returns 3.4%. So not a hugely profitable exercise if you're an investor at the moment, I think, unless you look for capital growth. But on those numbers, I don't think you're going to see much capital growth anytime soon. Okay, what else? Let's going to do a couple more and then I'll look at the chat again. This is another one down in Victoria. This is actually Paran 3181. And the interesting thing about this one is that this is a postcode with a few problems, as I'll show you in a second. This is a 3-bedroom, 2-bathroom house. They're saying the gross investment yield is 2.6 to 2.1. So even they're saying it's not a particularly good yield. I've got a slightly different number in my model, but that's okay. And it was at 2 to 2.1 million on the 14th of July. On the 17th of July, it was 1.9 to 1.95, so it's already slid back. And that's been listed 57 days ago. And looking at the data on that particular postcode, 10,000 households, we've got 25% borrowing, 57% are in mortgage stress, 50% of renters are in rental stress, and overall 47% of households are in financial stress. And the best scenario is 6% over 3 years. The base is 16% down, and the worst is 34% down. And the net investment return, well, 0. So you don't make much in terms of the cash flow on those properties in those areas. So you can sort of see why it is that maybe some of those properties are actually where they are. Now, let's have a little look back at the chat and see what is going on. Lots of questions, lots of postcodes. Goodness me, this could be a long show. Oh dear. Okay, error 404 2612. Thank you for the super chat. You see, you stand out when you've got the super chat. Oh goodness. Goodness me, what's that? Hang on. We have a doggy. We have a doggy move. We're having a bit of a wobble. There you go, just to prove that the dogs are actually still, they're not stuffed, they are real. Okay, 2612. Okay, so this is 2612. I'm just going to take the chat off so you can see it. 8,600 households, 17% own outright, 29% borrowing, 53% renting. So there's a lot of renting going on there. 22% in mortgage stress, 74% in rental stress. That's a problem. And 34% of stressed investors as a result of that. 57.6% of households in financial stress. That's quite a big number. Scenarios, up 6% best scenario, down 16% base scenario, and down 35% for the worst case. And interestingly, the investment returns are a little stronger in my model, in this particular one, which is 4.3% gross and 0.9% net investment returns. So there you go. Let's have a look. Interesting question here. Can your postcode summary data incorporate the number of estimated unoccupied properties in said area? Yes, the short answer is it is feasible to do that. There is that data. I've got all the census data, so all the data series that come out. I just have to go through and harvest that particular set of parameters and then plug it into the model. It's on my list of things to do, so you've prompted me to think about that. And 3036, you're suggesting, I assume you'd like the information on 3036. Let me see whether I can do that for you. 3036. Okay, ooh, not too good. Let me show that one. Take the chat off so you can see it. All right, now this is Keelior. Keelior, is that right? I don't know how you pronounce it. I get into terrible trouble with some of these names because I've never heard of them before, so I had to make it up as I go along. Quite a small postcode, 2,000. 63% of the 41% borrowing are in mortgage stress. A lot of rental stress as well. And overall, the number of households with some difficulty is quite high. So the best case scenario is a rise of 1% over 3 years. The base case is a fall of 21% for houses. Worst case is 40%. And I'd also highlight that the gross investment returns are 3.1, the net investment returns are down 0.2%. So not a particularly productive area for investment properties at the moment. Okay, what else have we got? So from Stripey Cat, thank you for that one, Stripey. Let's put that back up. I don't give financial advice, correct. Aussie property market in 12 months. Yes. Well, it depends on your scenario. Right? I've given you 3 scenarios, so you can pick your own. My own view is the base case scenario, and I think that the scenario is looking to me quite wobbly at the moment, because I do believe that rates will go higher for longer. And that takes us a little bit towards the GFC. Remember that we had this variable rate reset loans in the GFC. That was one of the main reasons why it was that they had an issue. So people took mortgages on low rates, and the rates went up dramatically in a relatively short term. That was actually because, guess what? The Federal Reserve lifted rates. And a lot of people suddenly found they couldn't afford the mortgage. Now, it may not be quite severe as the GFC, because I think, one, our banks are better capitalised, and two, our lending standards were a little bit better. But it's that sort of flavour. And the point about the US was not all areas of the US dropped the same. So there were some areas that dropped relatively just a little, and others that dropped dramatically. But the high leveraged areas, where people had borrowed to the gunnels, were the ones where they had significant issues. That's how I'm thinking about it at the moment. Okay, let's have a look. I've got lots of other questions which I probably won't get to. I must tell you that I've got so many things going on here tonight that I may not be able to cover them all. If in fact you don't get your question answered and you still like information about a particular postcode, you can always contact me via the blog. And if you ask for a specific postcode, I will send you that information back over the coming 2 or 3 days, because I want people to have that access to that information. I think it's quite important that people actually see how things are developing at the moment. So even if I don't answer it on the show tonight, there is another way of getting hold of it. Or indeed, as I say, you can subscribe via Patreon if you'd like to get the whole series, and then you can sort of look at it over a period of time as well. Because I actually think some of the movements over time are also quite interesting. Okay. Let's have a look. What do we got here? Okay, Perth viewer. Hey, 6060. We must keep our Perth viewers happy. Tony LeCantra is coming on in a couple of weeks, by the way. 2 weeks' time, Tony LeCantra will be on from Perth with his inimitable style and probably a presentation or two and some bad jokes too. So make a note of that. 6060, which is Yorkine. That's right. Let's put that up. There you go. All right. 12,000 households. 34% are borrowing. 58% of those are in mortgage stress. 63% of renters are in rental stress. And overall households in financial stress, 51%. So that's quite significant. And looking at the scenarios, well, you might, if you're lucky, get a 9% rise over 3 years, or a base case, a fall of 13% over 3 years, or a worst case, down 31% over 3 years is how I'm seeing it. And the net investment returns at 0.8%. That's positive, 0.8%, but still not particularly useful in terms of returns. And Drew said, that was quite funny actually. Drew said, David Llewellyn and Tony LeCantra going head to head would be fun. Yeah, I can just imagine that. No, I can't. Oh dear. Yeah, that might be hard to moderate. But I'm still prepared to do 2 people on the same show, you know, for a bit of debate. We've had a few debates over the months and years, but I'm waiting for good suggestions and people who are willing to come on and do that. Now, this is one from Ash has asked, you can ask 4110? Sure can. 4110. What's the time now? 9:03. Okay, we've been going an hour already. Can you believe it? Doesn't time fly when you're enjoying yourself? Okay. Whoops. Sorry, let's go back to there. Push the right button, get rid of that. Got too many buttons going on here. Okay, so this is... got the right one, 4110, yep. Okay, so 4110 has got 5,600 households, 49% are borrowing, so that's one of those high, I suspect a high development area, growth area, 58% in mortgage stress, that's a high number, some rental stress, overall household financial stress at 44. Nevertheless, we're looking well, best case scenario 19% over 3 years. The base case down 2.7% over 3 years. The worst case down 21%. And typically up in Queensland, the gross investment returns are 4.7, the net investment returns at 1.4. So they are actually better. I do see that quite a lot across the board at the moment, that investment returns up in Queensland and indeed also in Adelaide and Tasmania are significantly better than in Victoria, New South Wales, and indeed even Canberra. Okay. James asked, how's the real estate developer stress? Well, we know that developers are falling over left, right and centre. I've got no way to track that because, of course, there's no early warning. You know, it's not like this where I've got all my survey data coming through. I've got no means of actually understanding how many households, how many businesses, other than my SME surveys. Now, in the SME surveys, I do have some information about how businesses are thinking and how confident they are. And confidence has been ebbing away from the construction sector for about a year. So that's pretty loose, and I really don't have another way of doing it at the moment. And I would also ask you please to like the show if you've not done so yet. It's very important to sort of boost the algorithm, try and get people to give it a go, because put a lot of work into these, and I would like to be able to propagate it out. I think it's really important that people see this information so they've got a better understanding of what's really going on, and not just the high-level spruik from the real estate sector. Now, Gimpy 4570. Yes, very interesting postcode. This. Now, this is, of course, is a stress postcode because they had floods. Just bear that in mind with the Mary River. 18,000 households. 18,000 households, and 38% of borrowing, 22% renting. Mortgage stress is at 19%. Bit of mortgage stress there. Nevertheless, the scenarios are growth of maybe 20% over 3 years. Base case down 2.7 over 3 years. Worst case down 21% is what I'm seeing at the moment. Net investment returns 1.5%. Gross investment returns 4.6. But I must warn you, of course, again, flooding. You've got to look at the flood maps if you're looking at that area, because there are a lot of properties that are actually very prone to flooding, and they probably don't have as good a value history going forward. Okay, there you go. Can you do 3165? Yes, I can. 3165. All right, so this is that so you can see it. Okay, Bentley East, 32% owning outright, 43% borrowing. There's 11,400 households there, 24% renting, and there's 33% in mortgage stress and 50% in rental stress. A bit of investor stress too. So we have a best case scenario of 10.8% over 3 years, a base case of down 12%, a worst case down 30%. Net investment return is minus 0.6. So once again, we find that in these Victorian suburbs, the investment returns are pretty flaky. Okay, another one coming up. Right, that one up. There we go. 2097, please. 2097 it is. Okay, so this is Collaroy. In fact, we've got some cookie examples from the Northern Beaches. We might touch on some of those in a moment or two. 5,700 households, 34.5% own outright, 42% of borrowing, 22% of renting. There's not much mortgage stress. There's a bit of rental stress. So cumulatively 14% best case, 9% down worst best base case, and 27% worst case. And the gross investment returns 3.4, the net investment returns 0.1%. I will also highlight the taxable average income in this particular postcode, $112,000. It's quite a lot higher than many others around the place. Okay. 4341. Okay, 4341. So 4341. Sure can. Okay, so this is Laidley Heights in Brisbane and Moreton Bay. 5,900 households. 49% of borrowing, so a lot of mortgaged households. 80% in mortgage stress. 81% in rental stress. 15% in investor stress. Scenarios, 10% best case over 3 years, down 12.5% base case, down 31.3% worst case. And investment returns 4.2 compared with 1.2 net. Average taxable income $67,085. All right, so the question now is, do I go on going the ones in the chat, or do I come back and do a few more from Cookie Boy? I think what I'm going to do, just to mix it up a little bit, let's look at a couple from Cookie Boy and look at some of those. I think that's what we'll do now. So we'll go there. I think I did that one. Okay, this is quite interesting. This is St Kilda Road. So this is an apartment in the centre of Melbourne. 3004 is the postcode. And this was on the market at 2.1 to 2.3 on the 26th of July. It's now on the 18th of August on 1.995 million. 2 beds, 2 baths, 2 garages, apartment unit flat, gross investment rental yield of 1.56%. It's pretty unexciting really, isn't it? And so that's that one. We might go on and look at another one. So this is another one in Victoria, 3067, and this is an apartment in Abbotsford. Last listed, 2.3 to 2.5 is where we started quite a long time ago. Then it was last listed at 2.3 to 2.5, and now it's on at 1.995. So you can see that there's been quite a drop there. I find this quite often when I look at units. Unit prices are sliding. Here's another example, another Victorian one, 3104, Baldwin North, vacant land. And it was on at 2.5, 2.3, now it's on between 1.9 and 2.09. Gives you a bit of flavour of what's happening to land as well. Ivanhoe East, Victoria, 3079, a 3-bed, 2-bath, 2-car house, listed 27 days ago. Was on at 2.1 to 2.25. Now it's on at 1.925 to 2.1. So a bit of a slide. Another one at East Melbourne, 3002, the postcode. Listed 81 days ago. It's a house, 3-bed, 2-bath, 2 garage, 2 to 2.2 now. It wasn't at 2.2 to 2.4 back on the 7th of August. A week later, it was dropped by 200,000. And here's another one, Altona, 3018. It was actually listed 530 days ago, which just seems a long time ago. Anyway, in 2021, it was at 2.55 million. Now it's on at 2 million. It's a big drop. And here's one at Sandringham, 3191. Listed 17 days ago. Was on at 1.9 to 2.05. Now it's at 2.05 to 2.15. So here's an example of a property going up. Interesting. There are a few of them around. Not many, but a few. Another example here. This is actually one at South Yarra, and was on at 1.9 to 2.05. Now it's on at 2.05. So again, prices in some parts of Victoria going up just a bit, but maybe not everywhere. Don't know. Interesting one. This was on at 1.8 to 2. Now it's on at 2.045. Essendon. So people are trying to push the market higher. On the other hand, if you look at Killarney Vale in New South Wales in 2261, this is a 4-bed, 3-bath, 4-garage house, and the price guide is 1.4 now. It was on previously at 1.55. That was on the 16th of August, now on the 31st of August, so it's dropped, enough to notice the difference. And here's another example, Ascot Vale, Victoria, 3032, was at 2.4 on the 26th of August. Now it's at 2.35 on the 6th of September. 3-bed, 4-bed, 3-bath, 4-garage house. And another one, this is Brighton East in Victoria, 3187. And it started at 2.6 to 2.8. It's now at 2.4 to 2.54, with a bit of long history to it. These ones from Cookie Boy are quite interesting, just to see how many times the price moved around. Kew East, Victoria, 3102, 4-bed, 1-bath, 4 garages. It's a house. Listed 127 days ago. Was on at 2.295. Now at 2.05 to 2.225. So I think they're trying to keep the aperture as wide as possible. And one more, Brighton, Victoria, 3186. Was on at 2.2 to 2.5. Now it's on at 2.1 to 2.3. So that's another significant fall in that area. And Ormond, 3204, 3-bed, 2-bath, 2-garage house. And was on at 1.9 to 2.05. Now it's at 2.15. So another example of a price going up. And finally, Bateau Bay, we'll just do this one, 2261. Listed 54 days ago, was at 2.35 on the 15th of July, now 2.1 on the 17th of August. Very interesting. So there's a few examples of stuff moving around. Okay. I'm still way behind on the old postcode bingo, but we'll do a few more. 2097 came up. So this is one from Style Play, 2097. Put that one up there. There you go. Get rid of that. Okay, so this is Coleroy, another one up in the Northern Beaches. And 45% rental stress, not much mortgage stress. 14%, 9% down or 27% down. And I make the point, a lot of the ones here, they have a smaller population base to start with. But I am surprised at how much of borrowing is going on. 42% are borrowing. Okay. Here's another one, 4370. 4370, thanks for putting that one in. 370. Please like the post while you're watching these. Would appreciate it. Okay, so this is Warwick in Queensland. 7,800 households. 32% of borrowing. 74% in mortgage stress. That's one of the highest I've seen. 67% in rental stress. Some stressed investors as well. Scenarios are best case up 11% over 3 years. The base case down 11% over 3 years. And the worst case down 29%. Gross investment returns 4.3 compare with 1.3 net investment returns, and the average taxable income 64,649, which is pretty much average, I think, for Queensland. Maybe a bit below average, actually, thinking about it. Okay, where are we going now? So Casso9 asks, can I do 3056? I sure can, if I can find a way of doing it. Whoops. Just misplaced my mouse. Got too many Mises going on at the moment. 3056. Okay. Just going to move that slightly higher so you can see the whole thing. Okay. So this is Brunswick in Victoria. 11,719 households. 28.9% borrowing. 54.6% in mortgage stress, 70% in rental stress, 41% in stressed investors, and 65% in financial stress overall. Scenarios are best case up 2.5% over the next 3 years, worst case down 38%, base case down 20%. Net investment returns 0.1%, and the taxable income $83,018. Okay. Another one. I think I've done that one. So I might possibly end up doing them multiple times because I can't remember all the ones I've done. But anyway, never mind. We'll see where we get to. Okay, so this one is Upper Coomera. No, I don't. We've done that one, have we? 24,000. 42% borrowing, 48% renting, 25% in mortgage stress, 62% in rental stress, and 49% in financial stress. The plus 36 months scenario best case is 16.8%. The base case is down 5.6%. The worst case is down 24.3%. And the gross investment returns 4.5. The net investment returns 1.1. Goes to prove again. If you want better returns, invest in and around Queensland. Okay. Thank you, Vanessa. Appreciate that. Yeah, we do try to give good advice where we can. So appreciate that. So do Mandurah. Reckon they're buggered. Yes, I can't remember what Mandurah's postcode is off the top of my head. So if somebody puts Mandurah in as a postcode, I'll look it up. Actually, I can tell you that Mandurah is not doing so badly as it was. Interestingly. So when I looked at it 2 or 3 years ago, it was right at the top. It's still up there, particularly in the investment side, but it's not as bad as it was. Okay. Just flicking down the conversation. A lot. Have I covered inner city Sydney yet? No, I haven't, but I do have some data on that. So we might look at some of those. Maybe we'll do that now. Let me just see whether I can find them in my... I have 200 properties loaded in from Cookie Boy over the last few months. And it's quite interesting, just trying to sort my way through them. I may have to do a video. Perhaps I could do a video actually and just show each one on screen, and then you can look at it. Maybe that's a way of doing it, because otherwise we're going to spend all night and the next day probably going through them all, just looking for the ones closer. And I know we've got them here somewhere, but I'm not sure where I put them. Let me just look through them. Okay, I remember those. Paddington, there you go. I have found Paddington. So let me put that up on the screen. So this is a house in Paddington, 3 beds, 1 bath, and a car space. 0 car spaces by the look of it. Was on at 2.8 on the 26th of August. On the 31st of August, it dropped to 2.6. And they're saying the gross rental yield is 2.8%. I'm actually quite interested to look at that postcode in my data too. Yeah, I thought so. So this is an interesting one insofar that the story here is actually quite complicated. There is around 7,000 households in this particular postcode. 27% are borrowing, a lot of renting, of course. There isn't much in the way of mortgage stress, but there's a lot of rental stress, and therefore a lot of stressed investors, and therefore a lot of households in financial stress. As a result of that, we are only seeing a 3% rise over 3 years as the best case scenario in this postcode. The base case is down 19%, and the worst case is down 37.8%. And I'll highlight that the taxable income, $135,888, that's pretty high. And the gross investment returns 3.6%, and the investment returns 0.4%. Here's another one in Paddington, which we'll go back to. So this is, again, a house. And it was originally on at 3.5, and then it was on 3 point auction around 3, and then 3.1. So it's on at 3.1 at the moment. A house, 3 beds, 1 bath, 1 garage, pretty small plot as well. And it does seem to be the case that some of those inner city properties are beginning to slide. Kingsford, this is another one which is not right in the centre of town, but it's quite interesting. Look at that one. So this was originally on at 3.3 back in May, and it sort of moved around a little bit. Now it's on at 2.75, 6 beds, 3 baths, 3 garages, and it's a house. Interesting. Bronte, another quite interesting suburb, closer into Sydney, of course. 4 bed, 3 bath, 2 garages. It's a house. And it was on at 4.05 million on the 23rd of August. Now on 29th of August, it's on at 3.8. And I will just put 3024 up, because that could be quite an interesting one to look at from a... Yeah, I thought so. Goodness. Just a bit more movement from the dogs, just to show you they're still alive again. I've got a monitor here so I can see when they're moving and I can bring them on screen. Okay, so this is Waverley, Bronte Waverley, 4,400 households, 31% borrowing, 21% in mortgage stress, 75% in rental stress, and overall households in financial stress, 78%. And this is quite interesting. So it's suggesting that the best case is a fall over the next 3 years. The base case is a significant fall of 27%, and the worst case is a fall of 45%. And I'd also highlight the fact that the net investment returns are also negative here as well, despite the high income. Now, this is one of those examples, and I have mentioned it, I think, before, about affluent stress. So upper echelon areas and properties aren't necessarily free of mortgage stress. That's something to, I think, underscore. This is a real patchwork story in a number of different areas. And we might just do this one. This is Potts Point. So this was on at 8.5 million. Now at 7.9 million. 8.5 to 7.9. Very large property, of course. And it's got 8 bedrooms, 5 bathrooms, 5 car spaces. But the square footage doesn't seem particularly large, so I'm not sure how that works. But there you go. So it shows you at the top end. And if I were to go for 2011 in my data set, I wonder what that would tell us. Yeah, I thought so. It is very interesting. So this is another example of a more affluent end of the market. Taxable income, $137,000 on average. There's 10,000 households, of which 70% are borrowing. Bit of mortgage stress, but look at this rental stress. A lot of renters, 65%. So a lot of renters in rental stress, a lot of stressed investors, 65%. And therefore the financial pressures are significant. As a result of that, maybe 2% best case over 3 years. The base case down 20%. The worst case down 38%. And the net investment returns 0.4%. How good is that? Okay. Now, I also noted, I'm going to go and do a couple of those. Okay. Northern Beaches. I've had a few people ask about Northern Beaches, and I thought I might just do a couple of those again. Thanks to Cookie Boy for throwing these up for us. So this is up in Avalon. In fact, I did spend some time looking in Avalon years ago when I was looking to buy. Ended up buying down near Wollongong, but that's another story. Okay, this is on Avalon Beach, 2107. Guide is 3.9 on the 13th of August. Now the guide is 3.675, and it's a 4-bed, 3-bath, 2 garage, 682 squares. And if I put that one in the system, 2107, yeah, it's quite interesting. So we've got 42% borrowing, We've got 42% owned outright and not much renting. Bit of renting, not a lot. 5,600 households. 8% in mortgage stress, 57% in rental stress. So household financial stress not that high. As a result of that, best case scenario, 7% rise over 3 years. Base case down 15, worst case down 33. Average taxable income, $128,000. And the gross investment returns 3.5, net investment returns 0.6%. Tells a quite interesting story, doesn't it? And here's another one. This is at Newport, again up in the northern beaches. And this one had an auction guide of 9 million and then is now on 8 to 8.5 million. 4-bed, 3-bath, 2-garage on just over 1,000 squares. And if I put 2106 in the system, you can see there that it's quite an interesting story. So this is a pretty affluent suburb, $115,000 on average. But we've got 39% borrowing of the 3,700, and 63% of those have mortgage stress. Rental stress is also very high, and therefore the overall financial pressures on this particular postcode are high. As a result of that, the best case scenario is a fall of 6.5% over 3 years. The base case is a fall of 29%. The worst case is a fall of 47%. And again, an example of more affluent stress. Okay, well, we're at 9:31, so we've already hit the deadline, as it were. What I'm going to do is just quickly drop down and bring out a few more from the chat. Can I bring up postcode 2200? Probably can. Okay, 2200, which is Bankstown, 15,300 households, 30% of borrowing, 47% of renting. And in terms of mortgage stress, 25% in mortgage stress, 75% in rental stress. So you've got sort of stressed investors and 53% of households in financial stress. Scenarios are up 5.5% over 3 years. Best case, base case down 17, worst case down 35%. Average taxable income about 63,000, and gross investment returns 3.5, net investment returns 0.3. So I hope that helps. See what else we've got. Yeah. It is. That's a very important observation that you've made there about the fact that you can have areas quite close together behaving quite differently. And that's partly maybe because of the different types of properties. Maybe one is closer to amenities than the other, or maybe just the different types of people who bought. But you've got to go granular. And I want to underscore this, as I always do. You cannot look at generic indices, average prices across Sydney or Melbourne, right? Because you can see here just how much variation there is as you look at this in more granular detail. And the point I want to make is that whether you look at Queensland or South Australia, or whether you look at Victoria or Western Australia, you've got to go granular. You've got to look at individual postcodes and individual suburbs within postcodes to understand what's going on, because you can look at two postcodes side by side and they're doing very different things and have very different trajectories ahead as well. So I absolutely agree with that. Okay. $4070. Okay, so this is Belbarry. And 4,200 households, 60% of borrowing, 13% of renting, 35% in mortgage stress, 100% in rental stress, but it's a low number, so don't worry about that too much. There's a bit of household financial stress. Best case scenario up 13% over 3 years. Base case down 8.9%, and the worst case down 28%. And 4.7% gross investment returns, net investment returns 1%. Okay. Jeremy says Essendon. Did I do Essendon earlier on? Don't remember. 3040. Maybe I did, maybe I didn't. I'll do it again anyway. I lose count. You know, there's nearly 2,500 postcodes in Australia. No wonder I go mad. Okay. 11,000. 34% borrowing. 30% renting. 84.8% in mortgage stress. 56% in rental stress. And quite a lot of households in financial stress too. As a result of that, best case scenario, flat over 3 years. Base case down 22%. Worst case down 41%. And net investment returns minus 0.3%. Another of those Victorian postcodes where people lose money on investment properties. Average taxable income, $104,000. There we go. I'm chasing. I'm trying to keep up. 3340, says Leonard. Sure can. Okay, 3340. This is Bacchus Marsh, close to Geelong. 9,600 households. 53% borrowing, so more than half the population have a mortgage. 56% in mortgage stress. 66% in rental stress. And 45% overall in financial stress. There is a scenario, best case up 7% over 3 years, but the base case is a fall of 15%, or worst case a fall of 33%, based on what we know today. Average taxable income is about $76,000, and the net investment return is minus 0.1%. Okay, the Shire, Nathan says. The Shire, please, the Shire. Yeah, okay. We'll do the Shire, 2229. Happy to help. 2229. Okay, here comes the Shire. 12,000 households, 40% borrowing, 24% renting, 11% in mortgage stress, 61% in rental stress, a bit of investor stress. Scenarios are best case up 10% over 3 years, base case down 12%, worst case down 30%. And the average taxable income, 105,000. And the gross investment return is 3.4. The net investment return is 0.3. 3030. Please, 3030. Give me 3030. Okay, we'll try 3030, shall we? All right, 3030. Here we go. This is Dermont. Now, this is an interesting one. 41,000 households. 49% of borrowing. That's 20,000. And there are 30.8% in mortgage stress, which is 6,200 households. That's quite significant. Quite a lot of stressed investors, but a lot of rental stress, 7,000 rental stress. Nevertheless, there's a rise of 11% best case, down 11% base case, down 29.9% worst case. And the average taxable income out that way is $77,000, according to the ATO. Gross investment return is 3.2. Net investment return is 0. Okay, what else? Okay. Leap videos. 3143. Sure can. $3143. Put them in the right order. 3143. There you go. So this is Armidale, northern New South Wales. 4,600 households. 25% borrowing, 45% renting, 33% in mortgage stress, 53% in rental stress, 40.3% stressed investors, and overall 63.4% in financial stress. So best case, down 0.4%. Base case, down 22%. Worst case, down 41%. Average taxable income, 140,000, which is quite high actually. And the gross investment return is 3.3. The net investment return is flat, 0. Here we go. Perth, said Andrew Joy. 6027. Here we come. Whoops. All right. So this is Heathridge in the district of Curtin. 16,000 households, 48% borrowing. Suggests it's probably a high growth suburb then. Some renting going on too. 37.7% in mortgage stress, 63% in rental stress, 17.2% stressed investors. Overall financial stress, 37%. 12.1% over 3 years, best case. Down 10%, down 29%, worst case. And the gross investment return is 4.1. The net investment return is 0.8. Okay. Stripy Cat. 3809. There we go, sir. Oh, interesting. 63% of borrowing. It's a very high number. 27% of renting. 87% in mortgage stress. 83% in rental stress. So high levels. And as a result of that, flat over 3 years, best case. Down 22%, down 41%. Gross investment returns, 3.6. Net investment returns, 0.5. Okay. Done Armidale. Did it. I did Armidale. Honest, I did. Okay, this one here. What about that one? 3212. Okay. This is Lara down Geelong Way. 6,800. 50% borrowing. 24.3% in mortgage stress. 92% of renters in rental stress. And as well as that, up 7.3% best case over 3 years. Base case down 15%. And the worst case down 33%. Net investment returns negative 0.1%. Gross investment returns 3.4%. Average taxable income $75,914. Yeah. Yeah, I know, Cookie Boy. That's exactly right. My CPU is about to blow. We got to 9:42. I think I'm going to call it a night on that one. So as I said, if you would like a particular postcode, and I haven't had a chance to do it tonight because of just too many requests, then feel free to send me a message via my blog, and I'll try and help. People are still asking. Hang on, we'll just do a couple more. 2133. A couple of people are logging off. Cheerio. Good night, those who are leaving. Oh, I don't have that one in the... It's too small a postcode. 2133, I think, unless I put it in wrong. Hang on. Let's try that one again. 2133. No. I can't do 2133. It's too small to be in my postcode. Sorry about that. A lot of thanks coming through. I really appreciate that. Okay, I'm going to call it a night there. I just want to say thanks very much for spending so much of your time with me. It's really appreciated. And just before I go, I will tell you that next week we actually have another property show, and that's going to be with Megan from Property Pursuits in Brisbane. I wanted specifically to focus in on Brisbane because there is a load of stuff going on in Brisbane, And particularly, the spruikers are still saying that property is going through the roof, but actually all the data that I'm seeing is otherwise. So Megan will be on next week at 8 p.m. Sydney time, so mark your diary there. And the week after that, Tanya LaCantra will be on, and we'll talk about the markets and those sorts of things there. And as I close, as I may have said before, if you do have issues with mortgage stress, it's important to recognise and react rather than just hope. And I remind you again that I put up the debt outline and the number earlier on. Go back in the show if you need to get that number. I'll put it in the comments below as well. Because it's really important to prepare for higher rates, which are coming and will continue to come for some long time. Anyway, without further ado, let me say thank you for watching. Thanks to Cookie Boy. We got through some of those, Cookie. I might do another show later, or I might do a video with some of them, maybe to music or something, so that people can see them all, because there's some really interesting examples we didn't get to tonight. But thanks for all your efforts there. Keep them up. Keep the information flows coming. And I guess the other last question to leave you with before I go is, do you want more of these types of shows? Because there is an argument for saying, well, maybe I should come on more frequently and do this sort of stuff. So in the comments, tell me what you think. And while you're doing that, let me just share with you the result of the poll, because I did actually ask a question earlier on. In a year's time, will property prices be higher, the same, lower, or impossible to tell? And interestingly, the result of the poll is as follows. We've actually got, oops, I've lost it. It's there somewhere. I saw it. Where's the poll gone? Anyway, it disappeared. I don't know where it's gone. It should be there. I closed it rather than... Okay, so basically most people said lower. 70% I think said lower. A few people said no idea. Very few said higher. So I think that probably tells the story. And I think it's probably right. My expectation is property prices will be lower in a year's time. So very important to understand where we are and keep track of things. Thank you so much for your time. Hope you found it useful. See you next week. This is Martin North from Digital Finance Analytics, signing off. Cheerio.